Hello, welcome to video lectures by Shivananda Sharma Memorial RV College. SSMRV College, one of the premier institutions run by the prestigious RV group of institutions, has come up with a unique initiative to engage students at the time of this unforeseen medical emergency caused by corona outbreak. As a socially responsible institution, we would like to connect academically with students to make good the losses caused. In this connection, I, Vidya.U.Jambagi of BCom department, has posted a video on the subject Advanced Financial Accounting on the topic Sale of Partnership to a Limited Company. Please watch the video till the end and like, share with your peer groups and subscribe to our YouTube channel. Thank you. In my two previous video lectures on the same topic, I had taken up a problem with solution under net assets method and net payment method. In this video lecture, on the topic of sale of partnership to a limited company, I have again taken up a problem with solution under lump sum method. Let us read out the given problem. A, B and C are partners sharing profits in the ratio of 1 by 2, 1 by 3 and 1 by 6 respectively. They decide to convert their partnership into a company, on which date their balance sheet was as follows. Balance sheet is given to us. On the liability side, we have creditors and capitals of the partners. On the asset side, we have buildings, stock, debtors. We also have provision for doubtful debts, cash, and profit and loss account. The new company took over the assets and liabilities and agreed to pay purchase price of rupees 32,900 by the allotment of 1,800 equity shares of rupees 10 each and the balance in cash. The partners agreed to share the shares in their profit sharing ratio, pass the journal entries to close the books of the firm, and also prepare the necessary ledger accounts. This is the problem given to us. They have given us the profit sharing proportion. We have P&L account on the asset side, so that means it is accumulated losses that needs to be distributed among the partners in their profit sharing proportion. The company is paying them purchase consideration, and the purchase consideration is directly given to us in the problem. So since the amount of purchase consideration is directly given to us, this is a problem under lump sum method. The purchase price is 32,900 and this is paid by allotting 1,800 shares of rupees 10 each and the balance in cash. So one important aspect in this problem is the shares which are allotted by the purchasing company in the absence of any particular instruction in the problem, they are distributed among the partners in their final claim ratio, which we have also seen in our previous two problems. But here in this problem, they have specifically given us the instruction saying the shares are to be distributed in their profit sharing ratio. So in this problem, we cannot apply final claim ratio. Only in the absence of any particular instruction we go with final claim ratio. If there is any particular instruction given to us, then we'll have to follow the same. So in this problem, they have asked us to distribute the shares to the partners not in their final claim ratio but in their profit sharing ratio. So as the first step, the purchase consideration is already given to us, which is 32,900. The second step is the discharge of purchase consideration. So this discharge is in the form of equity shares, which is 1,800 into 10. So that comes to 18,000, and we have cash, which is 14,900, which is the balance. So the total PC is 32,900, out of which 18,000 is shares and the remaining is cash. So both these steps are completed here. Next, the third step is to close the books of the vendor firm. So as per the problem, we'll have to pass the journal entries to close the books of the vendor firm. So the following entries are to be written in the books of the vendor firm. So the first journal entry is for transferring assets to realization account at their book values. So realization account data to various assets account. We have taken all the assets at their book values. We have taken debtors at 10,000, and we have provided for provision for doubtful debts in the next entry. We have also transferred cash, assuming that cash is also taken over by the purchasing company. So the second entry is for the transfer of liabilities at book value. So we have creditors and provision for doubtful debts. So both are transferred. The entry will be liabilities account data to realization account. The third entry is for the purchase consideration due by the purchasing company. So the entry will be purchasing company account data to realization account. The amount of purchase consideration is 32,900. The fourth entry is for the purchase consideration received by the vendor firm. The purchasing company has paid the PC partly in shares and partly in cash. So the entry for that is written down here. Shares in purchasing company account debtor 18,000. Cash, which is paid by the purchasing company, cash account debtor 14,900 to purchasing company account 32,900. So the PC is received. This is an entry for that. The next entry is for the profit or loss on realization. So whether realization has resulted in profit or loss. So this entry we need to pass after closing the realization account. We'll have to take the total of realization account, find out which side total is more, then we get to know whether realization has resulted in profit or loss. In this problem, realization has resulted in profit. So the entry is realization account debtor 4,500 to A's capital account 2,250, B's capital account 1,500, and C's capital account 750. Now just in case in your exam, if you are asked to pass only the journal entries, then you will have to fill in these amounts about the realization profit or loss only after preparing a rough realization account. Then the next entry is for the accumulated losses which we see on the asset side of the balance sheet. So we had P&L account on the asset side. which is nothing but accumulated loss. So this loss is distributed among the partners in their profit sharing ratio. So the entry will be A's capital account debtor, B's capital account debtor, C's capital account debtor to profit and loss account. So it is distributed in their profit sharing ratio. So the last entry is a compound entry for distributing both the equity shares as well as cash received from the purchasing company among the partners. Now, this entry is the total of the amount for the shares allotted as well as the cash balance that is due to the partners. So this entry again can be passed only after preparing partners capital account. Alternatively, we can also pass two different entries for distributing equity shares and for distributing cash. So for distributing equity shares, if I'm taking this or dividing this into two different entries, for distributing the shares, equity shares among the partners, the entry will be A's capital account debtor 9,000, B's capital account debtor 6,000, C's capital account debtor 3,000 to equity shares in purchasing company account. And the second entry will be A's capital account debtor 9,150, B's capital account debtor 2,500, C's capital account debtor 3,250 to cash account 14,900. So both equity shares plus cash is added here and thereby we are getting these amounts. For example, for A, the equity shares distributed are 9,000 and the balance of cash paid to settle his account is 9,150. So 9,000 plus 9,150 is 18,150. Similarly, for B, the shares distributed are 6,000 plus cash paid is 2,500. So 6,000 plus 2,500 comes to 8,500. Then for C, the shares distributed is to the extent of 3,000 and the cash balance paid is rupees 3,250. So put together it is 6,250. So if this entry is easy, then you can pass this. If you're finding it difficult, you can go for two different entries here. As I said, one for the equity shares distributed and the other entry for the cash that is distributed among the partners to settle their accounts. Next is to prepare ledger accounts in the books of the vendor firm. So the first account that we prepare is the realization account. Now since we have already prepared the journal entries, we are going to post these journal entries relating to realization account here. So the first entry is for transferring assets at book value. So it is posted on the debit side of realization account. The second entry is for the transfer of liabilities at book value, which is posted on the credit side of realization account. The third entry is for the purchase consideration due, which is posted on the credit side of realization account for the PC amount due, which is 32,900. Now, since all assets and liabilities are taken over, there is no question of payment of any liability or realization or sale of any asset, nor do we have any realization expenses given to us in the problem. So, thereby we take the total of this realization account. So the total on the credit side is more, which is 41,900. So which means realization has resulted in profit. The profits are distributed among the partners in their profit sharing ratio. So the total profit is 4,500, which is distributed to A, B and C in their profit sharing ratio, which is 2,250, 1,500 and 750. Next account that is prepared is the purchasing company account. So in purchasing company account, we write an entry for PC due on the debit side and for PC paid on the credit side. So for the PC due, the entry is purchasing company account data to realization account. So we have posted this on the debit side of purchasing company account, which is 32,900. On the credit side, how this PC is paid is posted, or how this PC is received by the vendor firm is posted here. It is received partly in shares, that is to the extent of 18,000, and partly in cash, which is to the extent of 14,900. So thereby the account gets closed. The total tallies. So the next account is equity shares in purchasing company account. So the equity shares of 18,000 are to be distributed among the partners. Now, since in this problem they have asked us to distribute it in their profit sharing ratio, we are going to do the same. So, 18,000 shares received by the purchasing company is distributed by the vendor firm to its partners in their profit sharing ratio, which is 9,000, 6,000 and 3,000. So the total of 18,000, which tallies here, and the account gets closed. The next entry, the next account, sorry, is the partner's capital account. So in partner's capital account, we are going to transfer the capital balance of partners A, B and C. Then we transfer the profit on realization. Since it is profit, we transfer this on the credit side. So if realization had resulted in loss, so this entry would have come on the debit side of partner's capital account. So since it has resulted in profit, here we have an entry on the credit side of partner's capital account. Then on the debit side, we have accumulated losses that are distributed among the partners in their profit sharing ratio. Then the equity shares are distributed. 18,000 worth of equity shares which is received is distributed among the partners, not in FCR, not in final claim ratio, but as per the problem, it is distributed in the profit sharing ratio. So it is 9,000, 6,000 and 3,000. And finally, whatever is the balance due to be paid to the partners is paid by cash. So the balance is due to the partners in order to close their accounts is, for A, we'll have to pay 9,150. For B, the vendor firm has to pay 2,500, and for C, the vendor firm will have to pay 3,250 to close their accounts. And finally, the last account that is prepared is the cash account. So the opening balance of cash 6,000, if I am writing it here on the debit side, then I will also have to pass an entry for transferring that opening balance to realization account on the credit side. Or alternatively, I can skip both these entries. So one entry, opening balance entry on the debit, as well as transfer to realization on the credit, can be skipped. Then the next entry is for the cash received by the purchasing company, which is 14,900, and how this cash is distributed among the partners to close their accounts, to settle their accounts. So The working note is given here for the distribution of shares in their profit sharing ratio. Thank you.